Good morning and welcome. My name is Doug Reeder. I'm the Executive Chairman of Sterling Seacrest Pritchard. We welcome everybody to today's program. For those who don't know us well, we're one of the largest privately held independent insurance agencies in the Southeast. We work in partnership with our clients and community to provide services, solutions, and support customized to today's dynamic marketplace. Our firm has a client-first philosophy and robust resource platform delivered by almost 300 colleagues across 8 offices in the Southeast. One of our key differentiators is deep industry verticals with dedicated teams, including healthcare, construction, real estate and hospitality, transportation, logistics, nonprofits, and private client risks. In other words, personal insurance. We also have a large benefits consulting practice which works across industries. We are also broker owned with a common long-term perspective and a commitment to educating and informing our clients, which is manifested in today's program. As part of our business transition theme that we have been revisiting periodically through the last couple of years, we are pleased to present a program from Willamette Management Associates, a recognized thought leader in the fields of business valuation, forensic analysis, and transactional financial advisory services. Ben Duffy, Mike Benz, and Kyle Wishing are here to teach us the hows, whens, and whys of business valuation, along with specific considerations for the construction industry. As most folks know, we're facing a potential capital gains tax increase, so I really appreciate these guys being willing to do this program because I'm certain that their dance card is full the rest of the year. Ben Duffy is a manager with Willamette's Atlanta office and performed valuation and transaction advisory services for private clients. Ben was a co-editor for the most recent issue of Insights, Willamette's quarterly publication, which you can probably get on their website, I'm guessing. Mike Benz provides valuation, advisory, and financial consulting services and manages engagements related to the valuation of closely held businesses, private securities, intangible assets, and intellectual property. Mike joined Willamette after 26 years in public accounting, where he provided financial advisory services to both private and public companies. Kyle Wishing is a vice president with Willamette's Atlanta office. He provides a range of valuation services for business owners and is Willamette's director of ESOP valuation services.
Thank you, Doug. We really appreciate this opportunity to speak to you all. We at Willamette Management Associates believe this presentation will be helpful to all of you. Considering pending tax law changes and current valuation multiples, you may be considering a transfer of business ownership. This presentation is designed to provide you with a basic overview of business valuation. We will specifically discuss why, when, and how a business valuation is performed. Additionally, we will discuss construction industry specific value drivers. Here is a disclaimer. The opinions and materials contained herein do not necessarily reflect the opinions and beliefs of the author's employer. And then I'm going to hand it off to Kyle.
Our topics today, as Ben mentioned, we're going to do the valuation overview, which is really a valuation 101 of understanding the different ways that professionals would look at how to value your business. And then we're going to look at construction industry considerations, which these are the things we want you to know how you can increase the value of your business, the different value drivers that are in your control, and then also talk about the market factors that affect the value of your business. So we've got a list of 10 common business valuation purposes. I like to think of these in 3 different groups. The 3 C's: consulting, compliance, and controversy. Consulting would be if management just wants an idea of the value of the company, to get a feel for their options going forward, if they're thinking about gifting going forward or a sale down the road. Compliance could be for a gift of shares to your kids or a gift to charity. The IRS needs a valuation for that. Equity-based compensation plans often require a valuation, or ESOP administration and purchase price allocation. Those are other compliance valuations. And then also controversies if there's a divorce, business divorce, or marital divorce. Those are a few of the things that we get involved with. And one thing that I want to mention here is a technical term called standard of value. And the issue with standard of value, there are different standards of value, and values different depending on the purpose. So if I'm doing a valuation for a gift, the standard of value is fair market value, which is a hypothetical willing buyer, hypothetical willing seller. And there's not a specific buyer. Whereas if I was advising one of you specifically, if I'm advising Willow Construction as to a potential target company, that's going to be an investment value. It's going to be strategic to your perspective. That's just an example of how the standard of value can affect the assignment and the ultimate value indication. I'll hand it off to Mr. Mike Bin.
Thank you, Kyle, very much. I think everybody in the room can hear me, and hopefully everybody online can hear me as well. As Kyle mentioned, valuations are utilized predominantly by business owners for a variety of reasons. We're going to touch on the three generally accepted valuation methodologies. So those, Doug, for instance, you've had a valuation. The Willow Group has had a valuation. You'll probably recognize some of these terms, and I'm sure most of the folks on the conference will also recognize these terms. But there's three generally accepted and widely regarded and relied upon valuation approaches: market-based approach, an income-based approach, and an asset-based approach. The based approach is often sometimes referred to as a cost approach. Within each one of these approaches, there are specific valuation methods. For example, under the market-based approach, there's a guideline publicly traded company method, which basically references market multiples that guideline public company shares are being traded at on an active market, i.e. the exchanges. There's also a guideline merged and acquired company method, which is actually transactions that have occurred within the same industry space. It's very informative, and we're going to talk a little bit about trends that we've seen over time, and we're going to present that to you here in just a little while. The income-based approach is basically comprised of two primary methods, one of which is a discounted cash flow method, which, folks from their college years, if they ever took finance or accounting, may recognize that term. It involves a forecast of future operating revenues and cash flows discounted back to a present value to come up at a value. That's a very oversimplified example, but we're going to go through an example in more detail. There's also a direct capitalization of cash flow method, which basically seeks to identify what a normalized level of cash flow the company could generate into perpetuity would be, and then you capitalize that valuation metric, i.e. normalized cash flow, at a capitalization factor or rate, which we'll show an example of that as well. The third area, asset-based approaches, two primary methods utilized under an asset approach, one being the adjusted net asset value method, and the other being the asset accumulation method. Again, we're going to show some examples of these, and I'm going to turn it over to Ben now for taking a deeper dive into some of these methods.
Thank you, Mike. So we're going to start off here looking at a market-based approach, the guideline publicly traded company method. Having a technical difficulty.
I'll mention one other thing on this slide, if that's all right. So just, these are terms that we throw around often. Market-based, income-based approach, asset-based approach. Just a different way to think about those. The market-based, you're just observing different transactions in the market. You're comparing your company to, a publicly traded company or another M&A transaction. The income-based approach, you're looking at an investor's returns. What are my expected returns going to be, and what's the risk-adjusted return? So there's a time value money aspect to that. Then the asset-based is, what's the cost to recreate this business based on the assets? And that's not just the tangible assets. You know, a lot of construction companies, most of the value is in the people. So there's a lot of value with the assembled workforce and customer relationships, that sort of thing.
All right, thanks, Kyle. All right, so here is an example of a market-based approach, the guideline publicly traded company method. I know it might look a little overwhelming when just glancing at it, but to just sum up what this method is doing is we are selecting guideline companies relative to the subject interests that we are valuing, companies that we believe are comparable, typically by industry, sometimes by size. A lot of times when working with smaller companies, it's difficult to find a public company that's going to be a comparable size. So therefore, we'll make adjustments to our multiples in order to account for that. So in this example here, we have some selected guideline companies. You'll see those at the bottom left of your screen. We've derived, based on the current market pricing, we've derived market multiples. These are shown at the top where it says GPTC pricing multiples. We have a range. We've selected specific market or specific financial metrics that we think are most applicable in the industry. A lot of people look at revenue, they'll look at earnings. In this case, we're looking at EBIT, which is earnings before interest and taxes, commonly known as operating income. And then we're looking at EBITDA, which is earnings before interest, taxes, depreciation, and amortization, which is operating income plus depreciation and amortization. We're also looking at a tangible book value to invested capital multiple. This is pretty common in the construction industry because if the industry is asset intensive, you might want to look at a asset-based metric such as this. Then once we select the applicable financial metrics, we typically observe multiple periods. In this example, we're looking at a 3-year average. We're looking at a latest 12-month period. And then we're looking at 2 projected periods. For the public companies, those are usually based off of analyst estimates. And then for our subject business, we're typically looking at the projections provided by company management. We then determine which multiples are the most applicable and apply an emphasis on them. In this example, we are just applying a 25% emphasis to each multiple. You'll see based on the median of the guideline public company multiples, we selected the multiple for our subject interest. And then after applying that emphasis, we get to a weighted value based on these various market multiples. This is a value conclusion on a market value of invested capital basis. This is a debt-free basis, so this doesn't consider the leverage within each of the businesses or our subject company.
Yeah, so Ben, EBIT and EBITDA, those aren't numbers that show up on my P&L. How do you look at those from a valuation standpoint?
Great question, Kyle. So from a valuation standpoint, we'll typically look at normalized earnings. If there was a one-off event, for example, a significant litigation issue in one year that you don't believe to be recurring, we'll adjust that out of the earnings figures. So in order to derive EBIT, we typically take operating income. In order to derive EBITDA, we typically take operating income plus depreciation and amortization, both of those being adjusted for non-recurring events.
Yeah, I just mentioned control issues as well there. If we're doing a value on a controlling basis, you may have normalization adjustments for, say, owner's compensation, or if there are, non-operating items that are run through the business, we would add that back because a controlling buyer would adjust those to some normal level. But on a non-controlling basis, you're sort of stuck with how current management is operating the company, and you wouldn't see those types of adjustments. So you can see a difference in the cash flow on a control or non-control basis. We're going to talk a little bit about the income approach. And it's funny, I guess, what we get excited about a DCF method as finance guys. We really love doing a discounted cash flow method. I guess I'm curious if you folks are familiar with that term, a discounted cash flow method. Okay, I'm seeing some nods. Generally, when we're interviewing folks that are interns, they'll say DCF method. That's a buzzword that they'll throw on their resumes, and you have to see if they really understand what it is. But every income approach is based on some projection of earnings and a discount rate, which assesses the risk of those earnings and the required rate of return that an investor would have. So what we have here is a 5-year projection of cash flow, and we're doing a business valuation. So we're valuing the firm. So we've got 5 years of cash flow, and we're looking at, in the middle of the line, in the middle there is net cash flow to invested capital. So that's all cash flow to debt and equity holders. So you've got, then a little bit further down, you've got adjustment for the present value factor. That is where we apply the discount rate and bring everything back to the current period to get what the present value of the business is. In this case, we used a weighted average cost of capital of 16%. Let's see, we've got the 5 discrete periods that are projected, and then we have over there in the right side is the terminal year, which the assumption in most business valuation income approach methods is that the business will continue into perpetuity. So there are some financial formulas that are used to estimate what the value of the business would be in year 5. So if you see equals terminal value 55.953 million, that's what we're estimating the value would be in 5 years. The present value of that is the 28.7 million. So there's a lot of emphasis on really the two main inputs. So a lot of emphasis on projections here. That's something from a valuation standpoint. We're going to ask if you've done projections before. I think in a construction context, I often get a lot of pushback when I'm asked for projections because it's very difficult to project what's going to happen past the first year or so. But often you'll have a better feel for what's going to happen after 1 year than simply slapping a 4% growth rate. We're just going to grow for 4% forever. So it's best to just get some indication of what you expect based on your business plans. What are you spending in CapEx? What are your initiatives for the company? This next slide shows the other side of the equation, which is the cost of capital. And we're looking at the weighted average cost of capital, or the WACC. So that's the cost of equity and the cost of debt. This company had really didn't have much debt at all. They had 3% debt in their line of credit. So probably a suboptimal capital structure, but just from a cost standpoint, so the 97% weight in equity and 3% in debt really ended up being basically where the WACC equaled the cost of equity. And this slide shows how we estimate the cost of equity. There are some market factors, the risk-free rate of return, that's based on treasury rates. So a 20-year treasury rate is what we would look at. Long-term equity risk premium, that's something that the market gives us. Then you look at you got an industry specific. So the industry risk premium for a general contractor was 3%. And this company is smaller than the industry, and so we apply a size risk premium. I think we'll talk a little bit about the size risk premium later on, and how investors tend to require greater returns for smaller companies. And then we also applied a company-specific risk premium just based on their mix of work. They had geographic and customer concentration that we accounted for there. This slide simply shows how we estimate the beta, which beta is how a company's stock performs relative to the market. Betas over 1 are generally cyclical companies, construction companies. You would expect to have betas over 1, which means that there's going to be a higher rate of return for that type of company than the market overall. There's generally more risk associated with those types of companies. You know, on the other hand, you've got say a utility would be a low beta type company. All right, Mike.
Thanks, Kyle. We talked a little bit earlier about an asset-based approach or a cost approach, because it's also sometimes referenced. This is just a real simple example of an asset-based approach. In this particular instance, what we're trying to do is arrive at an adjusted net asset value for a particular company. And what that typically means is we will make valuation adjustments to certain assets that appear on the company's balance sheet. In this particular instance, we noted that net fixed assets, which would be reflective of the historical or depreciated historical cost of the fixed assets, were marked to market value discretely, which resulted in a pretty significant increase in the fair market value of the net fixed assets. So if you were to try to sell the underlying net fixed assets today, the representative number might be closer to 11.9 million as opposed to the historical depreciated cost basis in those assets. In this particular case, we also made an adjustment for intangible value that would be in the nature of goodwill. This type of methodology is often utilized for holding companies whose assets are primarily the drivers of value. So you'll see this for real estate holding companies, for instance. This is a pretty popular method, as well as other types of companies that may not be generating a sufficient level of return that could justify the investment in the underlying asset base. So again, very simple example. What you do is mark everything to market. That would be both the left-hand side and the right-hand side of the balance sheet. Left-hand side being the assets, the right-hand side being liabilities and equity. So liabilities have to be stated potentially at fair market value as well. So that would require valuing debt, typically, if the company has any debt. And there's a variety of methods that are utilized for valuing debt, which we won't get into today. I'm going to turn it back over to Ben, and he's going to talk a little bit about some of the valuation adjustments that might be necessary, as well as get into some of the qualitative and quantitative factors that we consider for each company. Go ahead. Sorry.
Give us some insight into what you mean about the valuation of the debt. I guess I'm
sure.
I would think debt would be debt. Like it's,
yeah,
that's what we
sure.
know.
Yeah. Great question. Absolutely. So typically, debt, you may get debt from your bank or your lending institution, and that debt may reflect that institution's assessment, if you will, of your ability to pay the debt. In other words, a credit rating. And typically when we value debt, we will develop a synthetic credit rating based on certain ratios, debt service coverage ratios, et cetera. So if you think about debt back in the early 1980s, interest rates were as high as 20%, right? In today's environment, interest rates are substantially lower. So the face value of debt might not necessarily reflect the fair market value of debt based on gyrations in the interest rate environment and also gyrations in the subject company and some of their performance criteria that we typically look at.
So I guess I'm thinking out loud. You showed public companies on a prior slide there, and their debt would be, investment grade potentially. And
yep.
I'm a small company and I might be paying 5% for my debt, but they're only paying 3%. So
exactly. Exactly.
Gotcha.
Yep. Great way to just think about it. Yeah. Contingent liabilities can also come into play. For instance, there could be hazardous waste situations, or there could be lawsuits. I know in a lot of large construction projects, there's usually a significant number of claims that may come up, and oftentimes those claims have to be considered from a contingent perspective. So the realm of contingent liabilities and or assets for that part, for the most part, can run the gamut. We see a lot of construction companies that have corporate aircraft, for instance, or they may have, condominiums where they attend certain conferences that are utilized for business purposes, but also utilized for personal purposes. So we have to take all of those types of assets and liabilities into account when we do the valuation. I'll turn it over to Ben. Here you go, Ben.
Thank you, Mike. So here we have our valuation synthesis. This is where we're just weighting each valuation approach and method relative to our confidence in it. In this simple example here, we weighted each method equally: the discounted cash flow method, the guideline publicly traded company method, and the adjusted net asset value method. We had equal confidence in each. There might be instances, for example, we didn't feel confident in the projections used for the discounted cash flow method, so we might put a lower level of emphasis on that method. Or maybe we believe that the company is best valued by just liquidating the assets, so we might actually put all of the emphasis on the adjusted net asset value method in that case. So then once we equally weighted each of these methods, we derived about a $55 million hypothetical enterprise value. This is looking at the debt-free value of the company. We then subtract the interest-bearing debt to get the total market value of equity of the company. However, this is before adjustments. There are several adjustments we might apply at this point in the valuation process. One could be an issue of control. Is there some sort of strategic acquisition premium? Is this for a minority interest in the business? So we have to apply a minority interest discount. There's also issues of liquidity. Most of the companies we are valuing are private businesses. Therefore, they're not publicly marketable. If you were to try to liquidate your interest, you're going to have to probably find a broker. It's going to take you a little bit of time. It's not like just selling stock. So we apply a marketability discount. This can be anywhere from 5 to 40%, depending on how illiquid the assets are. Sometimes we'll also look at a blockage discount. If you own a very large interest, it's going to be even more difficult to sell. So we have to consider the blockage factor. And then we'll apply adjustments for non-operating assets and liabilities. So as Mike mentioned, there might be an aircraft in the business that's not fundamental to the operations. It doesn't contribute to the cash flow of the business potentially. So we might add back the value, the fair market value of the aircraft after looking at the operating value of the business. This also includes maybe some marketable security holdings or any other non-operating real estate holdings as well.
I guess one thing that we don't have on that slide is S corporation adjustments. I imagine that a lot of folks, their companies are structured as S corps. Ben, can you just talk to that?
Yeah, so an S corporation, instead of the corporation paying the income taxes, all of the income is passed along to the shareholders. It's typically called a pass-through organization, and the shareholders are then responsible for paying the taxes. However, under previous tax law, there was a significant advantage to being an S corporation in terms of the taxes you might be liable for. However, since the corporate income tax rate was reduced under the Tax Cuts and Jobs Act, that benefit has been reduced as well. Additionally, I believe some of the pending tax reforms might even further decrease the benefit of being an S corporation. I would say prior to the reduction in corporate income tax, the S corporation adjustment was anywhere between a 10% premium to a 15% premium or so to the business value. However, post Tax Cuts and Jobs Act, it's more so a 0 to 5% premium. So it's not as significant as a factor as before, but we still consider it in all of our valuations.
And I would just add that if you looked back at the slide that I did on the income approach, that applied taxes to income. We were looking at after-tax income, and that's generally how we're going to value S corps is on a after-tax basis, and then maybe make an adjustment at the end, because we're looking at public company rates of returns. We're looking at public company multiples. So basically, we value an S corp as a C corp, then make an adjustment. Also, just a lot of these things depend on whether it's a controlling interest or a non-controlling interest, like the level of a marketability discount. If you're a controlling shareholder, you can decide to go to market when you want to. There's going to be a limited discount for lack of marketability in that instance. But if I'm a 10% shareholder, and especially if the company doesn't pay dividends, then I'm stuck. I'm not earning any return, and I have no exit event in sight, so I can't force my hand there. So I just mentioned that control is a big issue, and we want to make sure that all the valuation approaches are on the same basis as we're going through an analysis. All right, bring us back, Mike.
Thanks, Kyle. As we mentioned at the forefront of the discussion, we want to speak specifically to valuation trends that we've seen within the construction industry. So Kyle's going to talk a little bit about public company multiples and transaction multiples for construction market participants. And then we're going to focus our attention on some of the key value drivers that are both qualitative and quantitative. Kyle?
All right, so these are our publicly traded company multiples. We just looked at a broad set of publicly traded companies there. They're listed off to the side. And we're looking at EBITDA and revenue multiples over a 10-year time horizon. And what you see there is that it's a seller's market right now. You've got multiples that are at the high end of the range where they've been historically, both on a revenue and an EBITDA standpoint. And we also looked at acquisitions that have occurred over the last 10 years, and we grouped those transactions into just 2-year time frames there. So we've got 5 different time periods that we're looking at. And the green column is for the EBITDA multiples. The yellow column is for revenue multiples. And we've got some 10-year trend lines there. So just looking at the average over the period. And what you see there is multiples were at their highest in 2017 and 18. They've ticked down some. The revenue multiple and EBITDA multiple are still over their 10-year trend. You guys have anything you want to add on that, or?
Transaction. It's important to note the transaction multiples are reflective of a control interest. In other words, the entire company or a majority stake in the company was sold. The public guideline public company multiples are actually on a minority interest basis. So there would need to be some adjustments made.
Guys, what type of contractor are these reflective of? So is it a general contractor, or? So because they look a little high to me based on what I know subcontractors trade at, and I just would want the audience to know. Yeah, they vary by type of contractor a lot, the multiple that would be paid, and whether strategic and but
yeah, I don't. The multiples are definitely high. I would like to. We could give you the detail on exactly what transactions were provided there. I don't think that these are going to apply to a lot of companies. Just
one of the other big driving factors in the construction space, based on our experiences, is whether you have a book of recurring revenue. So if you have a service and maintenance business, that's much more highly valued as opposed to having to bid to obtain all your work. And so, businesses like mechanical and electrical that have a big service component to them tend to trade at much higher multiples than just a straight design, bid, build contractor would.
Right. And these are a lot of these are strategic buyers, and they're getting a premium there by finding the right buyer. So Doug, I think you jumped ahead there a little bit with the. No, that's great. So just throw that out there. What are the primary value drivers of your business? I think Doug touched on one, looking at recurring work as opposed to one-off jobs where there's no guarantee of what's coming next. Any other value drivers that you folks think of, you folks online as well? I'm looking at you.
The things that we've observed over the years is that institutional relationships can be valued similarly to recurring, they're not true recurring revenue, but where there's a high bar to entry to competition, and and your company has a relationship with that institutional owner that's got a ongoing construction program, that can be highly valued by an outsider who can't break through that wall to get that client on their own without a combination.
Doug, I think we should get you up here. So we'll talk about some of the value drivers here. We listed a few. Doug, you touch on relationships, and the institutional relationships are definitely key. Relationships, that's a broad term, but customer relationships, the level of customer concentration that you have, these things, we're looking at these in terms of positives and negatives. They're things that we have to assess. The strengths and weaknesses of each company. So key relationships, if you have a lot of customer concentration, that could be an issue. On the other hand, I've valued companies that have 2 or 3 main clients, and while that is an issue, there's a lot of growth opportunity with those specific clients, and the growth opportunity outweighed the risk. We look at reputation when you're bidding jobs. Having a strong reputation is going to be really important. Having a good health and safety record is going to be important. Also, for retaining employees, your reputation obviously is a huge thing. I think, also just diversification in general is something that we're going to be looking at from a valuation standpoint for all of these main bullets. With the management, do you have a diverse management team, or is there just one or two folks that are really running the business and have all of the main contracts? Are those key managers incentivized to stay? Is there a risk of them leaving? Do they have an employment contract that is, commensurate with what they do? Ben?
Yeah, I can go ahead and elaborate on that. So the concern, and this is sort of a silly question we ask during most of our due diligence, is if this one person were to be hit by a bus, what happens to the business? And the concern is the business able to continue operating? Does it still have those key client relationships that it had prior to that person departing the business? And one thing that can help is if there's some sort of succession plan in place. If there's people that are positioned to take over that role in the near future under the instance that some unexpected event occurs. So one of the key aspects of valuation is determining risk and what sort of return you would expect by taking on that risk. And the higher level of risk, the higher level of return you're expecting, which would therefore increase the discount rate that we're applying to the future cash flows.
Yeah, I'd just say also that having the succession plan, we've seen times where there's a succession plan in place, but it's not communicated very well. And, you've got a senior leader who, when they name a successor, that next wave of leadership, can be some flight risk involved there, where they're not named leader and, all right, we're going to do our own thing. So having that in place and communicating it where everybody's on board is good for just maintaining the company's.
But if we both got taken out, I guess that's a.
Hopefully you both have your own private corporate jets to fly, so you're not traveling together. But no, I'm kidding. These are all great points, and these are all things that we consider because they could increase the level of risk associated with the performance of the business. We typically look for companies that have a variety of management capabilities in place so that there are, redundancies, if you will, or backups. If the strategic leaders or the leaders that are currently running the company, something may happen to them or they just decide they want to retire one day. So we look for multiple layers, if you will, of succession plan, especially when there are with companies that have a multitude of specialization areas in the construction industry, which is pretty typical. Doug, do you have a question?
One of the reasons we really like doing a program like this is all of these things are just, while they increase potentially the value of a business, they're also just good business. And so like the continuity, the valuation piece is something that your bank and your surety company are very interested in being informed about as well. And it like was stated, these are doing these things well, reduce the risk of the business. So even if you never sell it, it's still a good thing for everybody involved. We recently had a conversation with a client where we were in the process of
providing quite a large bond for the company. And we had this conversation around, this is a big project, what happens if you were hit by a bus? Does your wife have any idea what she would do? Let's talk about that. And it was really a very healthy thing to go through. And so that's one of the reasons we really like this kind of conversation, because it's not just about selling your company. These are all good things to consider just from a risk management standpoint.
Absolutely. Couldn't agree more.
Every company is different because we don't probably have the formal succession plan, but my 4 senior job superintendents have worked for me since the 80s. The 2 senior project managers have worked for me since the 80s. During the recession, nobody left. And the other element of this is we're not a top-down company in the sense that I go tell these guys, you need to charge, $6 a ton to place that crushed stone. We don't do that. The job superintendents and the project managers have a lot of autonomy. We don't look over their shoulder about anything. So if the 2 of us were to disappear overnight, the company could move forward. It would take some effort on somebody's part, but there are people in place there that could do everything that needs to be done. So it's a little more complicated than just, do you have a succession plan in writing?
Yeah, it's much more complicated, and there can always be potential risk within those project managers too. If that project manager were to leave, what happens to all the projects he was overtaking? Are there any concerns there? So that attributes itself to that diversification factor, where the more diversified you are in terms of amount of people involved on projects and the type of projects and who you're doing the projects for, the less risk there is associated with the business.
I would just add, Alan, that those were great points. I mean, having the right people is foundational, right? None of this is going to work if you don't. But I would tell you that the other company that I'm referring to could say the same thing, right? All his people were really long-term and loyal and all that, but it was a really healthy thing for him to sit down with them and say, hey, let's talk about this. What would happen? Because one of the risks that occurs that if somebody key does pass away is that immediately, how tough it is to get people, right? Every headhunter in town is going to be calling all your guys, and they're going to be offering them all kinds of money to leave. And in an individual circumstance, you could be at risk of somebody just saying, well, gosh, this is more money than I ever thought I could get. I need to do it. Yeah, it does. It does. But having the conversation so that everybody says, well, what we would do is X, and hey, that maybe there's some bonus money to pay them for doing that, sticking around, winding up the affairs of the company, that your wife might appreciate it, even if if you don't think the formality is necessary.
All right, continuing on, I'll just hit these points quickly. Some other important value drivers are specialization. If you're very specialized in a hot industry, I understand storage facilities are pretty hot, warehousing, data centers, all of those. If you're specialized in those industries, you have a competitive advantage. You're going to be very competitive for getting that type of work. If you're already specialized in it, you're going to be able to realize better margins. And as long as that industry continues to be hot, or you're able to easily pivot into one of those industries, your company is going to be more valuable. Technology can also come into play well. If your technology is deficient relative to your competitors, then an investor might believe there's going to be some additional capital expenditures to undergo after a transaction, so they won't pay as much for the business. You also might have some internally developed technology, some intellectual property that we would value separately, especially if we were utilizing an asset-based approach. We might value the intellectual property separately. We have several clients where they come up with their own processes that they might even apply patents to that have significant value to them.
Thank you. We wanted to talk a little bit briefly. I'll go over this very quickly. Financial drivers. So obviously, looking at the composition of the balance sheet, right? A strong balance sheet usually is well rewarded in terms of multiples, and or potential premiums. So a lot of construction companies employ a certain amount of debt. Having debt service coverage ratios is critical. Obviously, a lot of commercial construction company lenders want to see a debt service coverage ratio, which is basically operating income available to service both principal and interest as well as lease payments. You want to see that ratio at a minimum above 1, but for the construction industry, it's going to be usually quite a bit higher than that for a lender to get comfortable with making a loan. So the degree of leverage, the degree that you employ debt in the company, up to a certain point, it does actually add value because you have the deductibility associated with interest payments, which can add value from a perspective. However, once you cross a certain threshold, you may have minimized or excluded some of the people that would lend to you, and that could hamper your future growth or your ability to raise additional capital if you needed to in a quick manner. So we look at a lot of these different balance sheet compositions as well as ratios. We have this crazy mnemonic that we use in the valuation world called SIGL-PITL: size, growth, liquidity, profitability, turnover, and leverage. We typically consider all of those items when we develop both a quantitative and a qualitative assessment of a particular business that we would be valuing. So I'm going to kind of pause there. I'm going to turn it over to Kyle. He's going to talk a little bit more about some of these ratios.
Thanks, Mike. So these are ratios I'm sure you're familiar with. Obviously, profitability is important. I think that goes without. We'll look at what a company's return on their assets are, how efficient are they in terms of their assets and putting those to use. We want to make sure that a company we want to analyze whether a company's growing their equity on a book value basis, and we'll look at returns on equity and earnings margins. And then just from a sustainability standpoint, we need to be thinking about what the required capital expenditures are going to be going forward. Often we'll see a little bit of a disconnect. Sometimes we'll see like a pro forma projection that's prepared, and there may not be a necessary level of capital expenditures to meet what they've got in the projection. And so that's an issue we need to make sure that we understand. And then, as Mike mentioned, looking at debt service coverage ratios and leverage ratios. For private companies on the sustainability side, maintaining their current business model is it something that we'll look at, whether they're going to remain a family-owned business. Is there something in place to have they done sufficient estate planning, or is the company going to have to provide some liquidity for an estate? Or if a company is an ESOP, have they done sufficient planning to manage the repurchase obligation? Those are some of the things that smaller private companies and private companies in general have to look at that public companies aren't faced with, that can, obviously affect their available capital and business going forward. Ben?
I can speak on this. So some other risk factors we observe is leverage. If you're over leveraged, there's obviously concerns. Obviously, if you're considering any sort of transaction, whether it be an ESOP or some other sort of leverage transaction, you're going to want to make sure your bonding agency is familiar with it. You're going to want to make sure that you've spoken to them much earlier than later. You don't want to surprise anybody. Doing so just emphasizes that you are probably a riskier investment from their perspective and our perspective as well. Working capital is always important. if you're able to fund your working capital requirements going forward, if you have any sort of working capital deficiency. For a lot of our valuations, we're typically just looking at working capital on an annual basis. However, if you're in this specific industry, it's much more crucial to look at it on a monthly basis and typically over a long-term period of time. With the change in receivables and payables in this industry, there can be a lot of volatility. So we'll typically observe if there is volatility in working capital, look at what a reasonable level of working capital will be, and then as of whatever our valuation date is, determine what a standard level of working capital would be to see if there's excess or deficient working capital. Earnings volatility is also a concern. Maybe a business has about the same contracts with the same clients on an annual basis. They might not have as much earnings volatility. However, if they were to obtain one significant contract that contributes to maybe 30% of their earnings for 2 years and then that contract goes away, they're going to have significant earnings volatility, which increases the risk of the business. And then contracts risk. This is just to ensure that the contracts have safety nets so that if something is to go wrong, and I'm sure something typically goes wrong, you're covered substantially, and that you also have whatever sort of insurance necessary to cover you under those uncertain circumstances. And there are a few external factors that impact business valuation. What we've just been discussing are more so company specific. So there can be industry trends. Clean energy is popular, as I mentioned before. The storage facilities, warehousing, data centers are all popular. Your ability to pivot within those industries and take advantage of what is sort of the hot industry at the time is crucial to maintain your business and to add more value to the enterprise. Additionally, regulations can often impact the business. For example, if you had been insourcing steel from China forever, and then the municipality all of a sudden requires only U.S. steel to be utilized, and you don't have the supply chain set up in order to obtain that steel in a timely manner, then you might just be automatically off of the table in certain contracts, and not having the ability to sort of, I guess, predict the regulations as well as adapt to them quickly can be not really a value driver, but a negative factor. But additionally, these regulations will allow the businesses that are able to adapt quickly to create more barriers to entry, which allows them to potentially increase their profit margins and be a more successful business. And then I'll pass it on to Mike.
Yeah, I was going to talk very briefly on some of the legislative considerations. If anybody in the room is familiar with Senate Bill 54 in California, 2016 or 14, I think it was. I actually did some work for a construction company that specialized in certain areas. One of the businesses that they did have did a lot of work for turnarounds for petrochemical plants out on the West Coast, mostly the big refining operations. And what Senate Bill 54 defined was that all the petrochemical plants had to be serviced by skilled trade and labor, which effectively meant union shops. And the client that I was doing work for took note of this because it would have a significant impact on their operations in California because they didn't utilize union labor force. So ultimately what they ended up doing was paying a huge premium for a company in California that was a organized labor company, and they, effectively positioned themselves well for the future, but it came at a pretty significant cost. So in today's world, we have the impact associated with stimulus, where a lot of people are having difficulty trying to find good qualified workers because a lot of workers decided they're not going to work. They're just going to continue to take some of the stimulus payments that have been handed out by our government. The Paycheck or Payroll Protection Act, PPP loans, big consideration from a valuation perspective. Even though a lot of the PPP loans are subject to forgiveness, we have to take into consideration how that might impact a particular company. For instance, Ben and Kyle talked about working capital requirements. If you have a short-term loan that you have to service, et cetera, and if PPP was actually helping you service some of that debt, then we'd have to extract that or normalize what your working capital would look like without having access to those funds. The infrastructure bill, right? Huge. A lot of people are, salivating over the potential opportunities associated with the infrastructure bill. But what we're seeing in our government is lots of back and forth and lots of potential changes here and there and everywhere. So legislation can have a significant impact on valuation, as well as some economic factors just in general. The risk-free rate right now is, many people would say, is artificially low because what the government is doing to keep interest rates at the lowest possible level that they can to help guide us out of this, COVID-19 economy. Inflation, the impact on materials costs. Everybody, I'm sure in this room and online is familiar with what happened to the price of lumber. Fascinating. You saw it rise to meteoric levels and then come screeching back down. So a lot of these transitionary elements and economic cycles will have an impact on the valuation of a business. I'm going to turn it back over to Ben for some final thoughts.
Yeah, thanks, Mike. So we appreciate you all paying attention to this. I know that a lot of the valuation specific issues might be a little advanced unless you have some sort of finance background, but I hope you're able to get at least a high level overview of what goes into these business valuations and what sort of factors we're observing specific to the construction industry in order to perform a valuation for someone, either a general contractor, subcontractor, anyone associated with the construction industry. It's very unique compared to other business valuations, and there's significant factors that you have to be aware of when performing such valuations. So I believe just given the current valuation multiples we've mentioned, as well as the pending tax law changes, right now may be a time where you're considering a transition of business ownership of some sort. If so, it could be good to get an idea of what your company's worth and hire a valuation consulting team. Our firm's been around since 1969. We have 3 offices, one in Atlanta, one in Portland, and one in Chicago. We're typically thought of, as Doug mentioned at the beginning, as thought leaderships in the field. We're big on publications and education. Our founders wrote the initial book on business valuation, and they review all of our work product. So we appreciate the time, y'all. And if anyone has any questions related to any part of the presentation, feel free to ask now or to reach out to us via email. We have our contact information on the next slide.
Thank you so much, Ben. We appreciate you guys coming out and doing this. I know you're busier than you can be right now, I'm assuming. And thanks to all who attended. We do not have our next event scheduled, I don't think, right now, so watch out for our next invitation. We have a few new program ideas in the works and are strategizing on our 2022 program schedule. So if there are any topics that any of you would like to hear more about, please reach out to either me or Katie, and we'll take that under advisement. We're always looking for fresh topical things to speak to. So thanks very much, and that'll do it for today.